Guys, of course it's tax season right now, so I wanted to get into the age-old question and finally get an answer, get to the bottom of whether or not you can deduct the interest that you pay on your home equity line of credit from your taxes. Let's get into it. If you didn't already know, my name's Jay Costa. I'm a real estate investor, developer, and agent here in Northern New Jersey. And if you get any value out of this video, please smash that like button down below. Also consider subscribing. We are building a community here of like-minded real estate investors, especially ones that like to use the equity in the properties that they already have to build wealth in real estate. So definitely check out my previous videos on all of these things. I'll put a link in the description box down below, as well as up in the corner here, and definitely consider subscribing. We'd love for you to be part of the community. Now, onto the video. So as I've shared with you in my previous Heloc videos, some of them anyway, I did just recently acquire an investment property using my home equity line of credit. So I wanted to finally get to the bottom of whether or not I can deduct the interest that I pay on my line of credit from my taxes. Before I get started, a little disclaimer, I am no CPA, no accountant, no financial advisor, no attorney. I'm just an idiot real estate guy from New Jersey. So this is just my interpretation of what I can do based on my circumstances in the situation, based on my own research. More importantly, talk to a CPA or an accountant so that they can help you with your specific situation. So here's the deal. Can you deduct your home equity line of credit interest from your taxes, yes or no? The answer is simply, it depends, as always. And it depends on one thing. Basically, what you're using your home equity line of credit debt for. You see, to understand this, you have to go back to 2017 when they passed the Tax Cuts and Jobs Act. This act changed this rule that we're talking about dramatically. Before this act in 2017, but prior to that, you were allowed to deduct any interest that you paid on your home equity line of credit from your taxes every year. But after that act, it differentiated and segmented what sort of debt that you're actually taking out and what you're using it for based on two separate categories. Number one is home equity debt, and number two is acquisition debt. So what is home equity debt? What is acquisition debt? And what are the differences between the two? According to the act, acquisition debt is, quote, a loan to buy, build, or improve a primary or second home and is secured by the home. The phrase buy, build, or improve is very important here, as is the second part that says that it must be tied to that home. And it's important to know when we're talking about this, the difference between acquisition debt and home equity debt. Now, most original mortgage debt is acquisition debt because that debt is being used to acquire said property. But also, money and debt that you use to improve, add on, renovate that home is also considered acquisition debt because you're potentially acquiring, quote unquote, more value in that home. Now, home equity debt, according to this act, is something completely different. If the debt is being used for anything other than on that property, it is considered home equity debt. For example, if you use the home equity line of credit to pay off your student loans, go buy a car, or even went to go invest in a business venture, this is considered home equity debt, not acquisition debt, and it would not be tax deductible. Furthermore, even if you're using the home equity line of credit to go acquire another property, an investment property, this is not considered acquisition debt, even though you're acquiring a property because it's not secured by that specific home, that specific property. But if you have a line of credit on your primary residence, on a secondary home, or even an investment property that you already own, you can use that line of credit debt to renovate, to add on, to repair, and any interest that you pay on that home equity line of credit is tax deductible. But the key is that it has to be secured and tied to that property. This Tax Cuts and Jobs Act of 2017 also added limits in regards to how much interest you can actually deduct. As of now, after the 2017 Act, you're only allowed to deduct the interest on a combined loan amount of $750,000 or $350,000 if you're married but file your taxes separately. This includes all mortgages and home loans that you have. It would be a mortgage, a second mortgage, a line of credit, a home equity loan, and it is combined in regards to all of the real estate that you have. So with all that being said, is it still a good idea to use your home equity line of credit to go purchase or acquire another investment property, like you use it as a down payment or something, even though the interest that you pay is on the home equity line of credit is not tax deductible. The answer is still yes. You can learn more about this in a previous video that I did. I'll put a link in the description box down below, as well as up here in the corner. I made this video on how you can use your home equity line of credit to use it as a down payment on an investment property. So if you want to learn more about that, definitely check it out. But the answer still is yes, as long as two things are still true. One, your numbers still work, your rental numbers still work, or if it's a flip, if those numbers still work. And two, you have a clear and concise exit strategy in order to pay back that home equity line of credit. If you have any experience watching any of my previous HELOC videos, I always tell you guys to make sure that you have an exit strategy in place and a way to pay off that HELOC. Anything long-term, I do not suggest you use a HELOC for. And by long-term, I mean more than, say, about a year or so. It's probably the longest I would hold a large balance on a home equity line of credit. And the reason for that is because of the interest rates. It's a variable interest rate. So if the longer you hold on to something, the more at the whims of the market you are to sudden increases and decreases in interest rate. You should also know that if you already own an investment property and you have like repairs that you need to make, or you want to add on or renovate so you can get more, collect more rent from that investment property, if you use a home equity line of credit that is tied and secured to that specific property, you can use that line of credit for any repairs or anything like that, and the interest that you pay is tax deductible, so that's great. But you have to have the line of credit secured by that property. If you want to learn more about getting a home equity line of credit on an investment property, I made a previous video on that as well. Link in the description box, as well as up here in the corner. Fewer and fewer lenders are offering HELOCs on investment properties as the market has changed so dramatically, but there are still a good handful of them, so definitely check out that video for a couple suggestions. So quick recap for you guys. You can only deduct the interest that you pay on your HELOC on your taxes if you're using that money to build, add on, renovate, or repair that specific property that the HELOC is secured by. Number two, you cannot deduct the interest from the HELOC on your taxes if you're using the debt from the HELOC to go purchase another property, but it still may be a good idea. And number three, you are now limited to the total amount of interest that you can deduct on your taxes. Like I said, up to $750,000 of combined total home loans that you have per year, or $350,000 if you are married and file separately, not jointly. That is it for today, guys. Thank you so much for tuning in. Let me know what you think in the comment section down below. As always, let me know what your experience is with this. Do you have any experience before 2017, after 2017? And also let me know what your accountant and your advisors are saying. Maybe what I'm being told here in New Jersey is different than where you guys are from. So very curious about that. Let me know in the comment section down below, and I will see you next time.